Hello, everyone, and welcome to At Barrons. I'm Andy Serwer, and welcome to our guest, Cliff Asness, who's the managing and founding principal of the hedge fund AQR. Cliff, great to see you. Thanks for joining us.
Thank you, Andy. It's great to be here.
So tell us about AQR. It's a quant hedge fund, very big, 123 billion or so under management. What do you guys do?
We grew out of really academia. 3 of the 4 founding partners met in the PhD program at the University of Chicago in, I shudder to say, the 1980s. A lot of the original research there on what we now call factor investing. We didn't have that term back then. It's funny, you always look at history and you use today's terms for it. Things like low multiple stocks beating high multiple stocks, good momentum beating bad momentum. That's what I wrote my dissertation on. It's grown tremendously from that, both a number of factors and other things we do, things like machine learning. The world has changed, but it's all an outgrowth of that original academic research. And we use it to run portfolios, both hedge funds, as you say, where we take pride in actually hedging, meaning we're long and short a pretty similar amount, trying to be really uncorrelated. But we also do run long only beat the benchmark accounts, essentially using the same models just to know what to over and underweight. And we're 27 years in and, some ups and downs, but life's been good.
Yeah, I want to talk about that 27 years because longevity in the business is not necessarily a given, Cliff. And how do you explain that then, that you guys have done so well for so long? You have had ups and downs, though.
Yeah, of course. This sounds, too rah-rah for us, but we're true believers in what we do. So when you have downs, even if other people lose faith, we've had a lot of people stick with us, which is always nice. But even if that's not perfect, if you actually believe in what you're doing, it's not that hard. 27 years goes by shockingly fast. I'm still intellectually fascinated by both what we do already and the chances to always improve. I know my partners and colleagues are, so it's fun. And my wife tells me that I'm never going to quit because when it's going well, which is most of the time, I'm having too much fun. And the rare times it goes pretty poorly, I feel too much responsibility to leave. So there is a little bit of a, you might never retire. How should I plan for this?
Sounds like a full employment act, basically. So I want to dig into more of this quant hedge fund manager kind of thing.
Sure.
and understand that a little bit more. Is it relationships between, say, 2 securities and noticing discrepancies in pricing and leveraging off of that? Can you explain a little bit more what it is?
Sure. I'm gonna make it. I'm a little nervous. I know you could get it, but I'm going to oversimplify. And I get nervous. People will think this is all we do when I give these. But here's the simplest one out of academia. If you buy more profitable stocks measured by ROE, ROA, what's called gross profitability, the better ones going forward tend to outperform the worse ones. That's something almost any active manager would like. If you went to a Graham and Dodd manager, yeah, we like profits. Where Quant's a little different is if we were only doing that, and we do way more than that, but if we were only doing that, we would probably own 1,000 of the world's more profitable stocks globally. And we'd probably be short in a hedge fund world 1,000 of the less profitable ones, because we're not about knowing a lot about a specific company. You don't come to a quant to go, after Palantir's earnings, are they worth it? We don't know. We bet on statistics. But when you have 1,000 against 1,000, statistics starts to rule. Now, imagine you had many such rules. You also liked low multiples, and you didn't like high multiples, and you also liked both price and fundamental momentum. You like to be on the right side of recent events. You don't like high beta, high volatility. You can think of those all as separate trades, put them all together. You end up long and short, many stocks around the world, betting on averages, and you end up building a portfolio. Some modern things we're doing, again, in the ML world and what's called alternative data, start to stray from this a bit. But a lot of the core factor investing ends up looking very much like the things a traditional Graham and Dodd manager would like.
So it sort of suggests that the market is not efficient.
Oh, them's fighting words. You probably know this, but I was Gene Fama's PhD student
At the University of
Yeah,
Chicago, Gene
I
Fama.
TA'd his class for 2 years, and he was co-chair of my dissertation. I was immediately a bit of a drifter from even Gene. I wouldn't call a pure efficient marketer. He's very intellectually honest. He admits that's a very extreme hypothesis. Perfect is extreme, but clearly he's towards the efficient market side in a big way. I wrote a dissertation for him, one of the very early papers showing that momentum also works. So Fama and French had really looked at cheap minus expensive using simple multiples and small versus large. I was part of it's a few other authors, but I was very early in adding, hey, the last 3 to 12 months seems to keep going. That's not a great result for efficient markets. I remember one of the scarier things I ever had to do was tell Gene Fama that I have these results. I want to write a paper on simple momentum investing, and I distinctly remember mumbling the second part, and it works very well. And he was like, what was that? And I'm like, it works very well. And this is a warm story because he looked and he just said, if it's in the data, write the paper. And he was very supportive of it. So I was straying from pure efficient markets early on.
Right. It's interesting because a lot of times you talk about people who believe in inefficient markets are more people like Warren Buffett, who can identify value, very different from what you do using fundamental analysis. Maybe that's more of a loser's game, generally speaking, than believing in inefficient markets and being a quant.
Yeah. Well, in some sense, active management, deviating from cap-weighted indices, is always a loser's game on net. Bill Sharp did this arithmetic a long time ago. All of us add up to the market. So if you and I are both active managers and we're the whole market together, one of us wins, one of us loses, and if on net we're paying the trade and paying an advisor, it is a loser's game. There is an arrogance, which I have to tell you, to active management of any kind. Even though we're quant, I consider us active managers. There's an arrogance believing that you will be on the right side of that other people are making mistakes. A lot of what Warren Buffett believes is not that dissimilar from us. He doesn't think markets are perfect. He thinks he's identified opportunities. I think it's pretty good evidence that he's been good at that. We believe, we would call it behavioral finance. We put fancy geeky terms on it, but behavioral finance is a term that really just means markets are not perfectly efficient and we think we understand some of the biases. And so where Warren Buffett will take that philosophy, and we actually wrote a paper. It was one of our most downloaded papers ever called Buffett's Alpha, where we said, let's close our eyes and pretend Buffett was a quant. What would he look like? And it turns out the quant value factor, the quant profitability factor, and the quant stable low volatility factor explained a lot of his returns.
Right.
That doesn't mean he's not a genius. He was doing it 40 years before the quants.
Right.
But I think the similarity between very good active management where you don't believe in a perfectly efficient market doesn't mean the market's easy to beat. And good quant and good Warren Buffett style stock picking is more similar in philosophy, even if the implementations can look wildly different.
That's fascinating. I didn't even make that connection. Interesting. I want to shift gears and ask you about the current political environment. And knowing that you don't take that into account necessarily because you're just looking at the numbers. Having said that, do you or have you or are you going to change your thinking at all given what's going on in the current administration? What Donald Trump is doing with tariffs and government and bringing in Elon Musk, does that affect your thinking at all?
Very little, but not zero. And let me give you two examples. One, and we tell our clients this, is as good quants, we have models for what risk looks like, and we target a certain amount of risk through time. That can be defined differently. It can be defined as absolute risk versus a benchmark. We give ourselves the latitude, which we a handful of times in our history, to take less risk than the standard process would say. We do not give ourselves latitude to take more risk. I don't wake up and say, I feel pretty good today. Let's take it up a notch. But these would be examples like if we're one day away from the debt ceiling possibly being violated or something. Maybe fixed income's a little more volatile than our risk models think. We looked into, this was just last week because it was pretty timely, how sensitive we were to tariffs. And this is actually complicated to figure out. If you have 1,000 stocks around the world, long and short, what's your bet on tariffs? I think we did a good job. We went through and we looked at where each company sells, where they buy, came up with a model that said we are slightly long tariffs. I'm personally not a tariff guy. That the Quant models come out to a little bit long tariffs doesn't mean I like tariffs. And then Monday, we had not a blowout, but a pretty good day. Models don't work that well. They're noisy, but that one happened to nail it. If we had found last week in this analysis that we, through not explicitly doing it, just through the natural process, had a massive bet either that tariffs wouldn't happen or would, we would at least consider, probably still wouldn't do it. There's a high bar to do this, but we'd at least consider saying maybe we should take a little less risk. Same bets, we don't go change them, but maybe a little bit less. The other way I think it matters is we do think, and we love to geek up the terms all the time, but macro uncertainty, chaos, for want of a better word, is higher than normal. We thought that even before the Trump reelect. We've thought that for a few years, that there's a lot of more uncertainty than normal in the trajectory of the macroeconomy. And this is hard to quantify. Quant hates saying something's hard to quantify. But if you don't believe the uncertainty, whether you love what he's doing or hate what he's doing, if you don't think the macro uncertainty is higher now, I don't think you've been paying total attention. And one of the things we do, and I will now do a brief commercial moment, is we've taken that early stuff that I did on momentum for stocks, applied it to markets. And one of the many things we do quantitatively at AQR is we're trend followers. CTAs, managed futures, has been around forever. We've been doing it now for about 15 years. It has a property of doing better usually. It's not a guarantee, but usually when the world goes a little crazy. So all else equal, I like those a little bit more than I normally do, because I do think we're in a world of high macro uncertainty. Mm-hmm. So like I said, it rarely matters. Mostly we're trying to be very hedged and not take big positions on what politicians are going to do. But at the edges, in those small ways, it can matter.
All right, so on the margin, you have either identified or moved a little bit. And speaking of politics, you're not afraid to mix it up on X, right? I mean, you like going out there and getting into it a little bit, right?
As you asked me that, I can feel all of AQR saying, oh God, what's he going to say now? But
I just want to ask you about the process, not about what your opinion is necessarily, okay?
You know, I get drawn back to X all the time because what they call FinTwit, when it used to be called Twitter, just financial Twitter, is really great. There are a lot of really good people. And then once you're on it, and if you are cursed, right or wrong, with thinking that you're at all funny, and sadly I delusionally occasionally think that.
I think that we'll get to that in a second.
It becomes irresistible to occasionally wade in. My firm and my wife probably wishes I would do it less, but I do it largely because it's fun.
Or speaking of funny, you wrote what I think is a pretty hilarious piece recently called 2035, an allocator looks back over the last 10 years. Yeah. What was the thinking behind that, Cliff?
It was basically what I thought was a cute, fun way to softly say what I think is going to happen in the next 10 years. The central conceit and arrogance is it's looking back over 10 years. So if I were to make forecasts, I might say I expect somewhat less out of U.S. equities given their price to very high levels. I don't expect disaster, but I expect a smaller risk premium than normal, but a wide range in forecasts. You can say I expect lower, but you don't know. But when you look back over 10 years, you can say exactly what happened. So I'm able to say you only made a couple percent over cash. I can say that Bitcoin went to zero, and I'm going to say this, I can't believe on your video, but Fartcoin dominated the world. Yes. So that was pure humor. I actually don't believe that one's going to happen.
Yeah, I want to get into the crypto thing. You said we had thought it quite silly that just leaving computers running for a really long time created value, but then it turned out it really did build digital gold, and we learned scarcity of something leads to anything scarce going up forever, even if it's useless.
Yeah, that was total sarcasm.
So you're not a big believer in crypto?
I'm not. I'm fallible. There's some chance I'm wrong about this and it becomes money. But short of that, I don't see a use case for it. I see three uses as of now. One, to speculate on crypto itself. Two, war-torn countries. People talk about that. And three, to pay cyber ransom. We have never had to do that, but occasionally I hear people have to do that in crypto. Other than that, the crypto people used to talk about it becoming a currency. Now they've tamped that down and they talk about it being a, quote, store of value. I just don't get it. And maybe I'm getting too close to 60 to understand crypto, and there is some chance that I'm missing something. I wouldn't short crypto, by the way. You don't short near 100% volatility things and sleep well at night. That doesn't mean my conviction's any less. Every once in a while, particularly on X, someone will go, well, why don't you short it? I'll go, just because I think you're so nuts that it could triple tomorrow doesn't mean I think you're right. So I'm a cynic,
right,
who acknowledges he might be who acknowledges he might be wrong.
Another thing you've written recently is about private investments, which you characterize as volatility laundering. What does that mean?
You're going through like a roll call of everything obnoxious I've ever said.
Your greatest hits. Come on, Cliff.
It's what I mean there, and I've invested privately. It's private equity managers. I know many of them. There a lot of them are just
some of your best friends.
Literally true. I live in Greenwich, Connecticut, so it's not a coincidence. I've made that joke that the cliche is true in my case. But a lot of them are brilliant investors who understand more about individual companies than a quant can ever dream about. And a lot of them are very honest that they do risky things. There is a rather large corner of that world that is less honest, that reports, say, volatility numbers. Quants love stuff like that. So the S&P tends to be, in geek speak, without it defining it, 15 to 20% annual volatility. You will see charts come out saying that's the S&P, private equity is half that, is 7-8% volatility. And if I had hair, I'd be ripping it out at that point. If you're invested in privates because you think you have amazing managers whose skill at choosing companies and then improving those companies can overcome the rather massive fees that they charge, more power to you. If you're investing in privates because you think, or even worse, you think others will think, they don't move around a lot, so they're really like super safe. They're just equities. They're a mildly levered, concentrated portfolio of equities. Their real volatility is probably, 25, 30% in a portfolio. And obviously individual firms will vary. So if someone, as much of the industry is honest and upfront about it, I have no problem with it. But there is a segment of the world that is using it to take risk that they probably shouldn't be. And they're using the lack of mark to market as kind of cover. And partly it's just my competitive juices. We don't get to hide in the liquid world. When we're down, we say we're down. We don't go, well, we're right, so we're going to mark it to where we think it's worth, which they seem to get to do.
Right. Quickly, you're not a big fan of high hedge fund fees.
No, I was writing about this. We wrote a paper in 2001, I think. Don't hold me to the exact, plus or minus 5 years. I remember two periods well, the last 2 weeks and high school. Everything else in between is some amount of years ago. But I think it was around then. We wrote a paper called Do Hedge Funds Hedge? Where we concluded the hedge fund world was actually very correlated to just long-only equities. They hedge about half. They end up with a beta, again, more geek speak, of about 0.4, 0.5. But what's left over, most of their risk is from that beta. So given that, 2 and 20, which I don't know if very few actually get that anymore. Some of the multi-strats get more than that, but traditional hedge fund fees, I think, have come down.
2% a year and 20% of the upside, yeah. Mm-hmm.
But the classic 2 and 20 fee, we'll even charge it when someone asks us to do a very aggressive fund, meaning a lot of our capacity is used up with many of our strategies, but rarely. Most of the things we do are considerably lower fee than that, and I don't think many funds can justify 2 and 20, and the empirics bear that out. Data on the whole hedge fund industry is always lousy. A very small subset of firms report to the public databases, but the data that we have says they make after fees about their betas. They match the market. They don't seem to outperform or underperform.
There we go. And final question, Cliff, and it's kind of a big one. What mistakes do investors make?
Oh God, I've made all these, so I'm not just preaching from on high. The grandparent of all mistakes is having too short of a time horizon. That's too easy to say. I'll be a little more specific. I have written about investors having a momentum orientation at a value time horizon. Put very simply, momentum seems to be quite powerful at a 3 to 12 month kind of horizon. Good things happening, both price and fundamentals, on average, not for every single company, of course, tend to continue. Value probably rules at a longer horizon. Let's just pick 5 years. Buying what's beaten up and looking cheap on a 5-year basis seems to work. What a lot of investors, and some of them are very smart, very good investors, but I've been on a lot of investment committees where I've been part of it and I've seen this happen, look at that 5-year horizon and go in the direction of what has worked. They are investing as momentum investors at a horizon where it is smarter to be a contrarian investor on average. It's pretty easy to see 5 years of something going one way and be convinced that's the truth. When sadly, in statistical terms, 5 years doesn't actually often tell us that much. So that is one major one. Another one I like to bring up is over-focused on each line in the portfolio. Don't get me wrong, you should know what you own, but often people put together a portfolio precisely because each part doesn't wiggle at the same time the other one wiggles. They zig when the other zags. I've been on a lot of committees that do that. We'll spend all our time on the three losers in the portfolio. So one thing I do if I'm appointed to an investment committee, and if I get involved with a new organization, they instantly stick me on the investment committee, often to everyone's regret. But I'll say, all right, I know I'm not going to stop that, but can we also examine the 2 or 3 biggest winners? Because that's as anomalous and often can reverse. Finally, I'll give you one more. Over any horizon, don't mistake a valuation change for truth. If something has gotten doubly as expensive, and a classic way to estimate something is to look at a long horizon, 20, 30 years, and say, what's the average equity return? If the endpoints are fairly similar, this could be useful. But if it started out at a PE of 5 in the equity market in 1981 and ended up 30 years later at a PE of 25, you had a 5 times revaluation over that period. The returns over that period will grossly overestimate what you really should expect long term. And that seems really obvious when I say it, but that sneaks in a lot of places.
Fascinating stuff. Cliff Asness, thank you so much for joining us.
Oh, thank you. This was fun, Andy.
This is at Barrons. I'm Andy Serwer. We'll catch you next time.